Check 1, 2, 3. You might have surely heard the word central banks, but what are they actually? Are they normal financial institutions, or are they the banks that govern the entire monetary events of the country? Does every country have a central bank, or is a central bank just a single financial institution ruling the entire monetary function? Let us see what central banks actually are. Let us dive deep into the roots and learn what the central bank means. A central bank, monetary authority, or a reserve bank is an establishment that governs the currency and monetary policy of a country or monetary union and oversees its retail banking system. Unlike a commercial bank, a central bank maintains a monopoly of expanding its financial base. Most central banks even have supervisory and regulatory authorities to ensure the resilience of member institutions, thwart bank runs, and discourage irresponsible or deceitful conduct by member banks. Central banks in most developed countries are institutionally independent of political interference. Still, limited authority by the director and legislative bodies exist. Issues like central bank independence, central bank policies, and rhetoric in central bank governors' sermons or assumptions of macroeconomic policies of the state are a focus of friction and whine by some policymakers and researchers specializing in business, economics, and finance media. The usage of money as a unit of account predates history. Government control of money is written in the archaic Egyptian economy. The Egyptians estimated the value of goods with a central unit named shat. Like many other currencies, the shat was conjoined to gold. Government administrations determined the value of shat in terms of goods. Other civilizations in Asia minor later molded their currencies as gold and silver coins. In the medieval and early modern periods, a web of proficient banks was founded in southern and central Europe. The institutes constructed a new tier in the monetary economy. Government establishments still regulated the monetary system mainly through coinage primacy. Banks, however, could employ book money to form client deposits. Thus, they could issue, lend, and transfer money autonomously without direct government control. A network of public exchange banks were established at the beginning of the 17th century in the main European trade centers to consolidate the monetary system. The Amsterdam Weissel Bank was founded as the first institute in 1609. Further exchange banks were located in Hamburg, Venice, and Nuremberg. The institute offered a public infrastructure for cashless international payments. They aimed to increase the efficiency of international trade and safeguard monetary stability. The exchange banks thus fulfilled comparable functions to moderate central banks. The institute even issued their own currency called Mark Banco. The Bank of Amsterdam, established in 1609, is considered the precursor to modern central banks. The Central Bank of Sweden was founded in Stockholm from the remains of the failed bank Stockholm Banco in 1664 and answered to the parliament. One role of the Swedish central bank was lending money to the government. The installation of Bank of England, the pinnacle of which most modern central banks have been based, was designed by Charles Montague in 1694, following a submission by the banker William Patterson 3 years before, which had not been worked upon. In the 1690s, public reserves were in scanty supply in the Kingdom of England. The credit of William III's governance was ennobled in London that it couldn't borrow the $1,200,000 needed to finance the ongoing 9 years' war with France. To induce subscription to the loan, Montague offered that the subscribers be integrated as the governor and company of the Bank of England, with long-term banking benefits including the issue of notes. The lenders could give the state cash and issue notes against the government bonds, which could be loaned again. A royal alliance was endowed on 27 July via the course of the Tonnage Act of 1694. The bank was granted sole custody of the government's credit and was the only limited liability established authorized to issue banknotes. The $1.2 million was raised in 12 days. Half of this was employed to reconstruct the Navy. Although the institution of the Bank of England marks the birth of central banking, it did not have the functions of a modern central bank. To restrain the value of the national currency, to fund the government, to be the sole empowered distributor of banknotes, and to bear as a lender of the last resort to banks mourning a liquidity crisis. These modern central banking functions matured gradually through the 18th and 19th centuries. Although the bank was initially a private establishment, by the end of the 18th century, it was increasingly considered a public authority with civic responsibility towards maintaining a healthy financial system. The money crisis of 1797, pushed by panicked depositors withdrawing from the bank, led to the country pausing the convertibility of notes into specie payments. The bank was soon indicated by the bulliness of forcing the dealings rate to fall from overissuing banknotes, a bill that the bank rejected. However, it was evident that the bank was being feted as an organ of the state. Henry Thornton, a retail banker and monetary theorist, has been depicted as the father of the modern central bank. Until the mid-19th century, retail banks could issue banknotes, and local banking company notes were generally circulated. Many believe the headwaters of the central bank to lie with the course of the Bank Charter Act in 1844. Under the 1844 Act, Britain standardized bullionism, making a ratio between the gold reserve held by the Bank of England and the notes the bank could issue. The Act also placed strict curbs on issuing notes by the country banks. The bank bore the role of lender of last resort in the 1870s after the objection of the lackluster response of the Overend Gurney crisis. At the most rudimental level, monetary policy concerns designated from the currency the country may have, whether a decree currency, currency board, gold-backed currency, or currency union. When a government has its own federal currency, this involves the issues of some state of the standardized currency, which is a state of promissory note, money under specific events. Historically, this was often a guarantee to trade the money for treasured metals in some fixed payment. When multiple currencies are fiat money, the assurance to pay consists of the pledge to bear that currency to pay taxes. A central bank may use another nation's currency either instantly in a currency union or indirectly on a currency panel. In the later case, illustrated by the Bulgarian National Bank, Hong Kong, and Latvia, the regional currency is endowed at a specified rate by the central bank's alien currency holdings. Similar to retail banks, central banks maintain assets and incur debt services. Central banks make money by issuing banknotes and lending them to the government in exchange for interest-bearing investments such as government bonds. When central banks expand the money supply by a portion greater than the amount their federal governments determine to borrow, they may buy private bonds or assets denominated in alien currencies. The European National Bank pays its interest income to the Central Bank of the European Union associates countries. The U.S. Federal Reserve pays most of its proceeds to the U.S. Treasury. This revenue, emanating from the power to issue currency, is called seigniorage and usually belongs to the federal government. The state-sanctioned control to create currency is called the right of insurance. Throughout history, disagreements have been over this power since whoever regulates currency creation controls the seigniorage income. Central banks were inducted in many European nations during the 19th century. Napoleon created the Banque de France in 1800 to enhance the financing of his wars. Although central banks today are commonly associated with fiat money, in the 19th and the early 20th century, central banks in most of Europe and Japan were designed under the transnational gold standard. Collectively, central banks buy less than 500 tons of gold each year. On average, in 2018, central banks collectively held over 33,000 metric tons of gold, about a fifth of the gold ever mined. In 2016, 75% of the world's central bank assets were controlled by 4 centers in China, the United States, Japan, and Eurozone. The central banks of Brazil, Switzerland, Saudi Arabia, the UK, India, Russia each account for an average of 2.5%. The remaining 107 central banks hold less than 13%. The utterance of financial policy may also guide more scarcely to the interest rate targets and additional diligent efforts undertaken by the financial authority. The primary function of central banks is usually to sustain price stability, as described as a specific level of inflation. Inflation is portrayed as the devaluation of currency or the rise of prices comparable to a currency. Most central banks presently have an inflation mark of close to 2%. Economic growth can be improved by investment in capital, such as more or better machinery. A low interest rate implies firms can borrow money to invest in their capital stock and pay less interest. Lowering the interest is likely to stimulate economic growth and is often used to elevate times of low economic growth. On the other hand, extending the interest rate is frequently used in times of high economic growth as contracyclical instruments to keep the economy from overheating and avoid market bubbles. In the aftermath of the Paris Consensus on climate change, a controversy is now underway on whether central banks should also follow environmental objectives as part of their STIRs. In 2017, 8 central banks assembled the Network for Greening the Financial System to assess how central banks can utilize their regulatory and financial policy tools to aid climate change relief. Today, more than 70 central banks are an aspect of the NGFS. After the economic crisis of 2007-2008, central banks led to change, but as of 2015, their ability to boost economic growth has stalled. Since 2017, implementing central bank digital currency, or CBDC, has been discussed. As the end of 2018, at least 15 central banks were regarding enforcing CBDC. Since 2014, the People Bank of China has been toiling on a project for digital currency to make its own digital currency and electronic payment system. Understanding the central bank is now a difficult task. So what do you guys comprehend? Did you get to know what a central bank is? And how do they perform? And why do they exist? Comment down all your understanding of the central bank before getting here. Until then, adios.